When the stock market crashes, insane amounts of wealth seem to disappear almost overnight. Portfolios shrink, retirement accounts fall, and years of savings can vanish in a matter of days. Headlines talk about billions, sometimes trillions, being wiped out, and for millions of people, it feels like something real has been taken from them. Like, money has simply disappeared. But here's the part most people never stop to question. If trillions of dollars are being lost, who's on the other side of that loss? Because money doesn't just disappear, it moves. And once you understand how that movement works, you start to see something much deeper. Market crashes are not just periods of loss, they're also moments of wealth transfer. The real question is, where does the money go? And who ends up with it when the dust settles? By the end of this video, you'll understand exactly where the money goes when markets crash, and most importantly, who is quietly benefiting while everyone else is focused on the losses. To understand this, we need to start with what a market is. When you invest in the stock market, you're not putting money into a vault, you are buying ownership in companies, and the price of those shares is constantly changing based on what people are willing to pay. Not what the company is worth in some objective sense, but what the next buyer is willing to pay in that moment. That means something important. When your portfolio goes down in value, it doesn't mean money has physically left your account and gone somewhere else. It means the price of what you own has changed. Imagine you buy a house for $500,000. A year later, someone is only willing to pay $400,000 for it. On paper, you've lost $100,000, but no money physically moved. No one came into your house and took $100,000. The value changed because the market's perception changed. The same thing happens in financial markets. Prices move not just on fundamentals. When markets crash, here's what most people don't realize. A large portion of the lost money was never cash to begin with. It was market value, a constantly changing estimate of what assets could be sold for at a given moment. That value is not fixed. It exists only as long as someone is willing to pay that price. When markets fall, what's really changing is not money, it's price. And price in financial markets is determined at the margin. That means the last trade sets the value for everyone. A simple example is if one share of a company last traded at $100, every share is now worth $100 per share. But if the next trade happens at $80, suddenly every share is now valued at $80. No mass transaction happened, no money physically left millions of accounts. Just one thing changed: the price someone was willing to pay. So where did the money go? It didn't go anywhere, because it was never sitting there as cash in the first place. It was an implied value based on the last transaction. When that price changes, the total wealth changes with it. Forced selling is a major part of what happens during a crash because in real markets, price changes are often accelerated by forced actions. Not all investors have the luxury of waiting. Some are forced to sell. The people most likely to sell out are leveraged investors facing margin calls, hedge funds managing redemptions, institutions rebalancing risk, and funds following strict rules or mandates. When prices fall, these participants may have no choice. They must sell, regardless of price. And when forced selling begins, assets are sold quickly, often at lower prices, which pushes the market down further. But again, the money doesn't disappear, it moves from those who are forced to sell to whoever's on the other side of that trade buying at a discount. If you find this video useful, consider subscribing. I'm on a mission to explain the economic systems shaping our financial lives and how individuals can navigate them. So subscribe and turn on notifications so you don't miss the next video. When assets are sold during a crash, the seller receives cash. That cash does not vanish. It typically moves into bank deposits, money market funds, short-term government securities, or simply sits idle on the sidelines. So while asset prices are falling, cash in the system doesn't vanish, it shifts position, often becoming more concentrated and more cautious. When you step back, three things are happening simultaneously. Prices are falling, thereby reducing the paper value of assets. Ownership is changing hands through actual transactions, and cash is being redistributed from buyers to sellers. This is why the idea of trillions being wiped out is misleading, because it suggests money is being destroyed. But in reality, what's being destroyed is valuation, not cash. Financial markets are not containers of money. They're pricing systems. They constantly reprice assets based on expectations, liquidity, risk perception, and available buyers. When those inputs change rapidly, prices adjust rapidly. And because price is set at the margin, small amounts of selling can have a large impact on total market value, which is why trillions can disappear on paper without trillions ever physically moving. So when markets crash, money is not disappearing into a void, it's not being lost in a literal sense, and it's not sitting somewhere waiting to be found. Instead, the system is being repriced. Ownership is shifting, and cash is being redistributed across participants. This brings us back to the original question. When markets crash, where does the money go? The answer is, it doesn't go to one place, because most of it was never a fixed pool of money to begin with. It was a moving estimate of value, and when that estimate changes, so does the illusion of wealth. Once you understand that, you stop seeing market crashes as money disappearing, and start seeing them for what they really are: a rapid repricing of the entire financial system. In the next video, we'll look at where money goes first when the Federal Reserve prints new money. Subscribe so you don't miss it.